Today, global gold markets experience one of the most dramatic sell-offs in decades. Prices that had earlier been climbing into record territory suddenly reversed, with gold dropping more than 12%, slipping below $5,000 an ounce in the biggest intraday decline seen since the early 1980s. Silver and other precious metals were caught in the slide as well, with silver suffering one of its steepest drops in more than 40 years. This isn't just a minor fluctuation. It's a major reassessment by markets of what gold means today and why it suddenly lost its luster after a powerful rally. Let's unpack the core drivers of this shift, moving beyond headlines and into the structural and psychological forces at work. To understand the price crash, we need to first look at the context. Throughout 2025 and into early 2026, gold had been on an extraordinary run. The metal surged to record highs, driven by a combination of sustained geopolitical tension, inflation fears, and a weakening US dollar. By year-end, returns of more than 50% had been logged, one of the most memorable rallies in modern commodity history. Investors flocked to gold as a safe haven hedge against economic stress. Central banks were major buyers. Record inflows into gold-backed funds underscored persistent risk aversion, and geopolitical tensions kept money flowing into the asset. Gold's appeal was simple. When confidence falls, hard assets like gold benefit because unlike bonds or equities, they carry no counterparty risk and have intrinsic physical value. But markets are dynamic, not static. The fundamental reasons gold was rising reversed suddenly, and several forces converged to push prices sharply lower. The most immediate trigger was a seismic change in monetary policy expectations. Investors reacted strongly to reports that the US president would nominate a new Federal Reserve chair perceived as more likely to maintain or tighten monetary policy rather than ease it. This move shifted market expectations about interest rates, bond yields, and the US dollar, all of which impact gold heavily. Here's why that matters. Gold does not pay interest. When central banks keep interest rates low, the opportunity cost of owning gold is smaller. But when markets price in higher rates or delayed rate cuts, yields on bonds and cash rise relative to gold. Investors pivot toward interest-bearing instruments, reducing demand for non-yielding gold. What looked like a dovish future suddenly seemed hawkish, and gold's rally lost a key pillar of support. Concurrently, the US dollar strengthened sharply. Because gold is priced in dollars globally, a stronger dollar makes the metal more expensive in other currencies. Foreign buyers tend to retreat when the dollar rises, further reducing demand. This combination of hawkish monetary expectations and a stronger dollar created a powerful headwind. But beyond macroeconomic forces, technical and market structure issues played a key role. After gold's parabolic rise, many traders and institutions booked profits, selling positions to lock in gains. This profit-taking pressure becomes especially intense after extended rallies, and once selling begins, it often triggers automated liquidations. In markets dominated by momentum and algorithmic trading, such forced liquidations can cascade quickly, pushing prices down even faster than fundamental news alone would suggest. In futures markets, margin requirements were raised in response to volatility. Higher margins mean leveraged traders must post more capital to maintain positions. When prices start to fall under that pressure, unhedged and leveraged positions get unwound, adding to the downward spiral. These kinds of technical feedback loops aren't immediately visible on macroeconomic charts, but they amplify price moves. Another factor is the shift in investor risk behavior. As recent economic data pointed to stable growth and lower inflation pressures, some market participants reduced their safe haven exposure. That means less demand for gold and other defensive assets, with capital rotating back into equities and risk assets. When risk appetite returns, gold can quickly lose its shine. It's also worth noting that the sharp sell-off coincided with improved prospects around geopolitical risks that had been previously priced into gold. When tensions ease or geopolitical fears abate, even slightly, a portion of the risk premium stored in gold prices unwinds. Markets don't wait for perfect peace. They react to perception and sentiment, which can be fluid. So what does all this mean? The gold market's plunge isn't simply one thing. It's a confluence of macroeconomic shifts, technical selling, speculative profit taking, and changes in investor psychology. It's a reminder that markets are forward-looking. Prices rise when the future feels uncertain, and they can fall rapidly when perceptions of risk and monetary policy change. For investors and viewers seeking clarity, this move should not necessarily be interpreted as the end of gold. Many analysts point out that long-term fundamentals, like central bank accumulation, global debt levels, and ongoing geopolitical risk, remain supportive of precious metals. A correction after an outsized rally is normal. What's important is distinguishing between short-term volatility and long-term trend shifts. The takeaway is this: gold's recent crash was not caused by a singular, isolated event. It was the result of multiple overlapping forces: monetary policy expectation changing, a stronger dollar, profit-taking after historic gains, technical market conditions, and shifting investor sentiment. Any one of these alone might cause a pause or a correction. Together, they produced one of the sharpest moves the market has seen in decades. For those holding physical gold or long positions, this may feel painful in the short term. For traders and speculators, these moves represent both risk and opportunity. The core lesson is that gold, like all financial assets, responds to expectations about the future, and when those expectations shift quickly, prices can move just as fast. In the coming days and weeks, markets will continue to digest these signals: the real yield environment, the strength of the US dollar, and global economic data. As this unfolds, price action will reflect not just fundamentals, but the psychology of markets, always forward-looking, always dynamic. Now that we've unpacked why gold's price fell so sharply, it's important to consider what this means for investors, markets, and the broader financial system. Sudden moves like these are never isolated. They ripple across commodities, equities, currencies, and even political perception. When gold drops this dramatically, it sends a signal to the entire market ecosystem. Risk sentiment is shifting, liquidity is being repriced, and the rules of engagement for investors are changing. One of the first things analysts look at after a major sell-off is whether this represents a temporary correction or a structural shift. In the case of gold, historical precedent suggests it's more likely a correction. After all, gold has weathered numerous shocks over the past century, from the global financial crisis to hyperinflation scares, from geopolitical flare-ups to monetary tightening cycles, and yet, in almost every instance, it rebounded. The reason is simple. Gold remains the ultimate non-sovereign store of value. No currency, bond, or bank account can match its intrinsic liquidity and universal acceptance. But the short-term pain is real. Market participants now face heightened volatility. Futures contracts are choppy. Margin calls are affecting leveraged traders. And ETFs tied to gold are seeing rapid inflows and outflows. In this environment, every headline, a Fed speech, a jobs report, a CPI reading carries amplified weight. What would normally cause a mild price fluctuation now triggers sharp swings as the market recalibrates. Looking forward, there are several key factors to monitor. First, U.S. monetary policy. The Federal Reserve's actions remain the single most influential driver of gold prices. If the Fed signals that rates will remain high for longer than expected, it will likely continue to suppress gold in the near term. Conversely, any hint of rate cuts, dovish rhetoric, or slowing inflation could reignite a rally. Investors need to watch not just the policy decisions, but the market's interpretation of those decisions, often expressed in futures, treasury yields, and the dollar index. Second, the US dollar itself. Gold and the dollar are inversely correlated in most cases. A strong dollar reduces the appeal of gold for foreign buyers, while a weakening dollar makes gold cheaper and more attractive globally. Currency markets are notoriously fickle, but shifts in the dollar's trajectory will have immediate implications for gold prices. In particular, any geopolitical event that weakens confidence in the dollar could quickly reverse this recent decline. Third, inflation expectations and real yields. Gold is often described as an inflation hedge, but more accurately, it responds to real interest rate, the nominal rate minus inflation. Even if nominal rates are high, if inflation expectations rise faster, gold may regain value. The interaction between interest rates, inflation, and investor expectations is complex, and small changes can produce large swings in precious metal markets. Fourth, geopolitical risk and systemic shocks. Gold's appeal surges when the world feels unstable. Conflicts, trade disruptions, or crises in the financial system can trigger rapid buying. The recent dip may be a function of temporary optimism. Investors rebalancing portfolios, geopolitical tensions easing, and risk assets regaining favor. But a sudden shock could cause a snapback rally, often much faster than the initial decline. For practical investors, what does this mean? The first principle is to maintain perspective. Selling in panic during a volatile correction often locks in losses unnecessarily. Long-term strategies, diversified portfolios, measured allocations to precious metals, and awareness of macroeconomic cycles tend to outperform reactive trading. It's also worth considering opportunity cost. For those with capital available, dips like this can be a chance to increase exposure at lower prices, provided one accepts the inherent volatility. Additionally, investors should monitor the technical side of the market. Support and resistance levels in gold futures, ETF flows, and open interest in options markets provide insight into how traders are positioning themselves. Technical signals often amplify or dampen price action. For example, when key support levels break, it can trigger automated stop-loss orders that exacerbate a decline. Understanding these mechanisms helps frame whether current price movements are likely to continue or reverse. The psychology of markets cannot be overstated. Fear and greed drive short-term fluctuations more than fundamentals. The past few days have demonstrated how quickly investor sentiment can flip and how fragile confidence can be in highly leveraged markets. Social media, news cycles, and analyst commentary amplify reactions, sometimes disproportionately. Savvy investors recognize that emotion-driven volatility is an opportunity, not a signal of permanent change. Finally, it's worth noting the broader macro trends influencing precious metals. Global debt remains at historic highs, central banks continue to accumulate gold, and emerging markets are diversifying reserves away from traditional currencies. These structural factors suggest that while short-term volatility may dominate headlines, the long-term story for gold remains intact. Over months and years, geopolitical tension, monetary policy shifts, and systemic risk will continue to underpin demand for precious metals. In summary, the recent gold crash is a multi-layered event. Hawkish monetary policy expectations, a strong dollar, profit-taking, leveraged positions, technical market dynamics, and shifting investor sentiment all combine to create a sharp decline. It's a stark reminder of how interconnected modern financial markets are and how quickly a seemingly stable asset can swing under changing conditions. For anyone observing or participating in the markets, the lesson is clear. Stay informed, remain patient, and differentiate between short-term noise and long-term fundamentals. Gold may have lost some ground in the past week, but its intrinsic value, historical resilience, and strategic importance remain unchallenged. Understanding the interplay of global economics, policy decisions, and market psychology is essential to navigate both the storm and the calm. Those who grasp these dynamics will be far better positioned to make decisions not out of fear, but out of insight. As we continue to watch these markets, it will be fascinating to see how sentiment, policy, and risk appetite evolve. Will gold rebound sharply, stabilizing near prior highs, or will this correction extend further, shaking confidence before long-term fundamentals reassert themselves? The next few weeks will provide answers, and investors who observe carefully may gain an edge in a market defined by its rapid and sometimes unpredictable swings. The key question on everyone's mind is, where does gold go from here? Short-term volatility, like what we've just seen, can be disorienting, but the market is never without signals. Analysts are watching multiple indicators simultaneously: inflation trends, Federal Reserve statements, bond yields, currency fluctuations, and global geopolitical developments. Each of these factors has the potential to either reinforce the recent decline or spark a recovery rally. One scenario is a stabilization near current levels, where gold consolidates after its sharp drop. Consolidation often occurs when markets digest a sudden move. Profit-taking slows, leveraged positions are unwound, and new buyers enter opportunistically. In this scenario, prices may hover just below previous highs, offering a base for potential long-term growth. Experienced traders often look at these consolidation periods as the best entry points, provided they maintain a disciplined risk management approach. Another scenario involves a resumption of the upward trend, particularly if external pressures shift. For instance, if inflation spikes unexpectedly, if the dollar weakens, or if geopolitical tensions escalate, any of these could rapidly restore gold's appeal. Historically, gold has often surged in response to crises or uncertainty, reflecting its role as a hedge against systemic risk. This reinforces a fundamental principle. Even when prices fall dramatically, the underlying value proposition of gold does not disappear. Conversely, there is also the possibility of further short-term declines. This could occur if interest rates remain high, real yields rise, or risk appetite in global markets strengthens further. When equities and other risk assets become more attractive, capital rotates out of defensive investments like gold. In these conditions, even minor economic optimism or positive data releases can exacerbate selling pressure as traders adjust positions in anticipation of returns elsewhere. For individual investors, navigating this environment requires discipline, patience, and perspective. Panicking during a rapid sell-off can result in locking in losses unnecessarily. Long-term strategies such as maintaining a diversified portfolio, allocating a measured portion to precious metals, and using dollar cost averaging for physical gold or ETFs remain the most reliable approach. Short-term traders, on the other hand, must closely monitor volatility, technical signals, and macroeconomic announcements to identify actionable opportunities. One practical takeaway is to observe the interplay between fundamental and technical factors. Fundamentals, like inflation trends, central bank policies, and geopolitical risk, set the stage, but technical dynamics often dictate the pace and extent of price movements. Support and resistance levels, open interest, margin requirements, and algorithmic trading patterns can all trigger rapid swings. Recognizing these interactions is critical to making informed decisions rather than reacting emotionally. Another insight comes from sentiment analysis. Investor psychology can amplify movements as fear and greed interact with market structure. During this crash, fear drove rapid liquidation and amplified the decline. Conversely, the same psychological forces could accelerate a rebound if optimism returns. Monitoring investor sentiment through market flows, ETF activity, and futures positioning can provide early indications of where the market is heading next. Long-term structural factors also remain supportive of gold. Central banks around the world continue to accumulate gold as part of reserve diversification strategies. Sovereign debt levels are historically high, and ongoing global economic uncertainty continues to create demand for hard, non-sovereign assets. These underlying drivers suggest that while gold's short-term trajectory may be volatile, its long-term role as a strategic asset remains robust. Finally, it is important to emphasize the educational takeaway. Markets are forward-looking, and volatility is an inherent feature, not a flaw. Gold's recent crash highlights the speed with which expectations can shift, how sentiment can influence prices, and how interconnected global financial systems are. For investors who study these dynamics, opportunities exist not just to protect wealth but to capitalize on market dislocations. In conclusion, the recent plunge in gold prices represents a complex convergence of macroeconomic, technical, and psychological factors. Hawks at the Federal Reserve, a stronger dollar, profit-taking leverage positions, and shifting investor sentiment all contributed. Yet despite this dramatic correction, gold retains its status as a strategic, globally recognized store of value. For viewers, the takeaway is twofold. Short term, be aware of volatility, monitor markets closely, and maintain discipline. Long term, understand that gold is not just a commodity, but a hedge, a safe haven, and a tangible asset whose value is resilient over decades. While markets fluctuate daily, the lessons gleaned from analysis, patience, and informed decision-making remain timeless. As we continue to monitor these developments, one truth remains clear. Gold's story is far from over. Corrections and sell-offs are part of the journey. But those who remain informed, strategic, and patient will be better positioned to navigate uncertainty and take advantage of opportunities when they arise. The market may be unpredictable in the short term, but knowledge, perspective, and prudence always provide a competitive edge.